I hand the floor now to Mr. Alberto Daroma, Head of Corporate Governance in Italy, in Georgeson. Mr. Daroma will coordinate a very interesting panel discussion with Mr. Fiorani, Mr. Herskovich, and Nezhla Mehmed. I think it's going to be a very interesting discussion. I will stay here and listen to you. I don't know if Mr. Daroma in Rome is ready, or is he having cappuccino? Oh no, you're ready.
Yeah, thank you, Chris. Thank you for the presentation, and I hope everyone can hear me well.
Yes.
Otherwise, just raise an hand, and I'll be able to make changes. And as you already said, yes, my panel composed of international representatives with the scope. The final goal I have in my mind is to provide to all our audience a brief, to the extent possible, understanding of which are the critical factors that an evolving market as the Greek one should care in terms of financial and pre-financial performances, because my point, and this is what I would like to underline, is that ESG is not just a matter of non-financial. ESG factors are the precursor of any financial performances. It's about the process the companies use in order to gain profit, grow. And so, by means of this little point of view I gave you, I will introduce to the panel Mr. Patrick Fiorani, who is the head of research in research and engagement in Glass Lewis, Mr. Michael Herskovich, head of corporate governance in BNP Paribas, a very important firm, specifically also involved, as we just heard from Mrs. Gusko, in publication in terms of environmental specifically, without forgetting social and governance. Mrs. Nezhla Mehmed, who is the corporate governance analyst in DWS Investment, a German investment firm that always put the ESG, in this case, I would say social, with particular attention to social factors, and Mr. Argiris Economou in Public Power Corporation, the general manager on legal affairs, with which we had the chance of speaking in last year, following the first Greek Corporate Governance Summit, and whose company gave us the idea, and more than idea, the sprint to push more on this topic, because what we discussed in Public Power Corporation was about using ESG factors in order to reflect the real potential value of the company. And this is something where the company itself is very active. So I will just make a round of presentation by each single panelist, starting from Mr. Patrick, just for a matter of order in our screen. Patrick, up to you. I can't hear you. I don't know if it's a common problem. Yeah, I don't know. Patrick, while the stage works on your PC, don't know why, I will go to Michael. No, it seems common.
You hear us at least.
Okay.
Can you hear me? No.
Yeah, yes, finally.
Okay.
Just wanted to cut some European countries because, well, let's say that female goes first.
That was your mistake, and that's why it didn't work. So as a matter of introduction, you already mentioned I am part of the Corporate Governance Center at DWS, which is one of the key pillars of our CIO Office for Responsible Investments. So what we did at DWS, we have established a dedicated office for responsible investments, which is part of our traditional chief investment office. And it is organized across various responsibilities, such as the corporate governance topic and team, ESG software data engine for our portfolio constructions and solutions, ESG integration, and also thematic research team. So all in all, we are 17 specialists dealing with ESG integration and engagement topics. And the entire Office for Responsible Investment supports basically our ESG integration activities, in particular across active and alternative investments, the ESG investment solutions, as well as product offerings. And what the corporate governance does, it also enables active ownership activities such as voting at general meetings, engagements, also for our passive holdings. So all in all, the proportion, I would say, of our assets under management in terms of asset class is 60% in active, approximately 20% in passive, 13% in alternatives, and the rest is cash. Complementing these activities of the Responsible Investment Center, we also have investment professionals as ESG specialists. So in practice, we have an ESG gatekeeper in every major investment team of the active platform. We have senior ESG portfolio managers, as well as dedicated sustainable investments team within the alternative space. So when it comes to active ownership activities, these are orchestrated by the Corporate Governance Center, which I am a part of, but the analysts of the active portfolio management are also actively participating in the voting process and also in the engagement process. And that is kind of the advantage of embedding our team into the active investment management business, as our interactions with the research analysts and sector heads on the fundamental side would potentially also benefit our passive holdings and our ESG analysis especially. So just to sum up, we are convinced that DWS, and I think the previous presentations gave a very good foundation on that putting ESG at the core of asset managers' fiduciary duties and activities really implies embedding it in the investment process and enhancing the fundamental analysis of the traditional investment process. So it is important to us that, in addition to aligning the client's investments with their personal values, striving to improve risk-adjusted returns and diversifying their portfolios, we can also help them achieve a positive environmental or social contribution as a team as well.
I don't know if Mr. Economou could give us some insight about Public Power Corporation and what Public Power Corporation is doing in terms of ESG, given the fact of its particular business is one of the first utilities in Greece, and so I guess it's a material company, a strategical one, and so stakeholder is a big word in their head. Mr. Economou.
Thank you for inviting me. And although I do believe that the life is full of surprises, I could not imagine that this particular conference might be triggered from a discussion that we had some months ago at PPC regarding those issues. Thank you for inviting me and being a part of this very distinguished panel. Before saying a couple of words about what we're about to do in terms of starting implementing ESG procedures and practices, let me just try to give you my input regarding those issues which have been discussed earlier during this very interesting conference. Now, it seems to me that the ESG agenda is nothing more and nothing less than an addition and a development of the ongoing discussion and process of introducing best practices in terms of what might be the correct question to the old question, to the correct answer to the old question: who is governing a corporation on behalf and to the benefit of whom? I'm referring it as a very old question because the very first who pointed out the potential distinction of interests between the ownership and the management of the company was Adam Smith in his Wealth of Nations book some centuries ago. So the way I see it, I think that the ESG agenda is an addition and an expansion of what was as a corporate governance agenda following the Berlin Means book in 1932 and the Cadbury Code of 1992, which developed into what we are saying GRC, where G stands for governance, corporate governance, risk stands for risk management assessment, and C stands for compliance. And I would be consistent with myself if I did not this time again point out that we should not miss the E component of the E and C programs, the ethics one. So it seems to me that the discussion about environmental and social governance issues is nothing less but a development to this very old process, which also constitutes a debate. The debate is more or less, is it really worthy? I mean, does it really add value to the company? In order to try to approach a question to this answer, I think that we should discuss a little bit about what the expectations in terms of operating a company are. Now, the expectation of a shareholder might be different to the expectation of a stakeholder. Shareholder value more or less leads to the increase of the value of the share and, of course, of the dividend. Stakeholder value might lead to other answers, which would fall under the well-known characterization of the corporation as the good corporate citizen. It seems to me that we need a balance between those two objectives. I would not like to in my lifetime to see a deepening of this distinction of interests between stakeholders and shareholders. The shareholders optimizing for the increase of the value of the share, and the stakeholders looking for, let's call it, more sensitive and socially attractive behaviors. Why am I saying that? Before joining PPC, I was in the private sector and I was conducting a number of due diligence exercises at companies which wanted to either launch their shares, IPOs in the stock exchange or issue secondary shares. My experience has been that not in all cases, but on a large number of cases, the former corporate governance debate was viewed as a burden and as a hurdle to the management of the company, which would like to be as flexible and as free as possible to manage the companies. And it is clear that corporate governance practices do constitute a checks and balance mechanism which limit the powers of the management. In my view, rightfully so.
I would say, if I may, and taking advantage of the last messages you sent us, I will revert this question to Michael at least, and then Patrick, because you said three words that for me are important: compliance, stakeholder versus shareholder, and corporate goals. So,
can I
given
add
the
just
fact
one
that we,
sentence? Just one sentence, because I will give
yeah,
you a fourth word.
yeah,
In my view, the ESG issues are nothing less but an expansion of the corporate social responsibility agenda, with one
and with
difference.
this word,
With one
I will
difference
move
that I'm closing now. The corporate social responsibility agendas are no more an issue of potential institutional investors, but also an issue of creditors. And I refer myself to this.
no, no, but that's specifically my point when I say non-financial are precursor of any financial performance in the end. But I was reverting to compliance, stakeholder, shareholder because the ESG is not just a matter of compliance for companies. Integration, stewardship are something where also proxy advisory firms, as well investors, as well companies are held to. And for this type of answer, I would ask to Michael who had and how BNP Paribas integrates the ESG factors and so how it fulfills its role of ensuring stewardship to all its clients. But in the most interesting question, we lost Michael. And so I will
Okay.
just. Michael, are you here? Okay, fantastic. Go on.
Perfect. Okay, perfect. Now it's working. Hopefully it will skip. Hello, everyone. I'm the head of corporate governance of BNP Paribas Asset Management. Just in a word, so we are an asset manager managing around 400 billion euro under asset management, having both passive and active, roughly a 50-50 approach. As you can see on my back, I'm based in Paris, even if I'm not in Paris today. So the way we integrate ESG is really something that is key and is done internally. And I'm going to both in voting and in ESG integration. So I'm going to explain quickly how we are organized in a quick snapshot. We are the ESG team / stewardship team. It's a team of 25 people. 2 years ago we were 10. So the team more than double on the last 2 years. But as you say, I mean, what is key, I think, is ESG integration. And the way we try to integrate the team on the organization is to constitute a community of ESG champions. There are 80 ESG champions on each investment team, each location. We have someone that can be the relay of our team and the way we approach ESG 2 years ago is as we have developed a policy to integrate in all our investment ESG so that every investment team has to have a better ESG score than the benchmark. So that's one example of the way we integrate a thing. Like financial performance, and a portfolio manager needs to have good financial performance, but on ESG, that's the same for us. He needs to have a better ESG performance than its benchmark as a manager. So we have integrate ESG. We have our own vision of stocks that we will buy third-party provider information, but just to gather information. Really, we do not care, and we can do a parallel for voting ESG. That's the same. I mean, we have third-party providers. They're here to help, but every ESG analysis, every view, every voting decision is going to be something that we take internally with our own opinion. So it's just a source, but it's something that we do internally. Maybe we can continue after that, but the way we have done the integration, so there are some companies that can be excluded based on ESG factors. There are some controversies, severe controversies. And there are a lot of companies that are not excluded per se, but because of the better than benchmark rule, if they have a bad score, bad ESG score for investment team, it's indirectly hard for them to invest in the low-rated stocks. And if they decided to do, we have a process for low ESG rated stocks because we consider that they have higher ESG risk to an obligation to start an engagement, a dialogue for companies that are low rated. So that's in a snapshot the way we integrate things. So some companies are excluded, some other are not on ESG, but if they have a profile that is not good on ESG, there is an engagement, an obligation of engagement, and for investment team overall an obligation to integrate ESG and to have a portfolio that has a better ESG profile than its benchmark.
You made a clear picture of what it is important to note, that it's not just a matter of voting. So it's not just a question that an issuer has to face in a general meeting. Is also a matter of investment decision. So ESG factors are considered throughout the year, and you have to care them without a proposal in mind, but with a strategic goal in mind. And considering this, I would ask to Patrick how it's complicated for Glass Lewis to answer all these requests from your clients that last years or maybe 5 years ago was just interested in understanding both for, both against on a single proposal, and now asks about wider, or I would say enormous range of information. How is Glass Lewis responding to these requests?
Sure. Maybe, first of all, a quick introduction. We're a proxy advisor. We provide research for investors worldwide on how, with voting recommendations on the AGMs of their investee company. There's about 150 of us in the research team, 40 in Europe, in Ireland, where our European research is carried out, and there's 4 of those on Greece, since this is sort of where virtually we're meeting. We solve the problem, or we get help from our partners when it comes to providing us more specific, more varied ESG data to our clients. We have a partnership with Sustainalytics, the data provider, and with the Sustainability Accounting Standards Board. It's a US-based organization that provides us with a list of material KPIs per industry for each company that we write research on. Whereas Sustainalytics provides us with a profile of ESG risk management, as well as a quantifiable controversy ranking. So these are data that feed into our existing report. As you mentioned, expectation has grown exponentially as to the influence, not just the presentation of the information, but the influence on our policy, our recommendations, because it does drive voting behavior of our clients. I guess where ESG intersects most clearly with the AGM, it is in remuneration proposals and on proposals for the re-election of directors. Remuneration maybe is the most straightforward. There's a growing number of ESG metrics that are over time accounting for more of the overall remuneration. While generally we're we could say agnostic as to what metrics are used, we don't have a framework that we wish to impose on issuers. They will have to be material, and they would have to be explained by the issuer in question. I mean, our SASB component in our reports has a list of key KPIs, but also companies themselves in maybe not so much in Greece where it's a new phenomenon, but in other markets where it's where this kind of practice has been around for years. Companies provide us with a rationale of why this KPI is particularly material for them. So they clearly disclose quantifiable metrics, but also provide a definition on how it's measured. In this aspect, a key thing to retain is that while we've agreed upon the meaning of financial indicators for the past 100 years or so or more, ESG indicators are newer. So not just the indicator needs to be explained, but also how it is measured. And then targets, of course, and why it's material to the business. Again, we're expecting to see more of this in Greece, worldwide, but especially in Europe, and we're going to have it's going to meet increased scrutiny essentially. When it comes to governance and the board, even though it may seem like the re-election of a director is not an ESG proposal, we monitor the board level oversight of ESG performance through the membership of a sustainability committee, a CSR committee, or committees who have additional responsibilities enlarged to include this kind of oversight. Not just the presence of the committee, obviously, but also its scope is something that we take into account, as well as we monitor the competence of directors, the skills. Yeah, that's a better word. The skills of directors, including ESG expertise that is material to the industry of the company that we're looking at. So this provides us with an idea of where the puck stops, as it were. So in a situation in which our partners highlight a severe concern or a significant concern with ESG performance, it's going to be reflected in our analysis then, and we will know exactly how the supervision occurred. Finally,
on that point, sorry, Patrick,
maybe,
we are running on time, and this point is particularly of interest for me, and the same question will be also for Nezhla. It's about monitoring, it's about assessing, but which are the channels that Glass Lewis, as well investors, uses? Because we heard from Sustainalytics, we heard about third-party advisors. Is all a matter of documentation that the company publishes, or which are the channels for engaging? Which are the time when a company should engage with you, and so on?
Okay.
What is physical? What is the direct? So you and Nezhla.
As you well know, Alberto, over the years, our engagement has grown exponentially. We've collaborated with Georgeson as well as other companies in your industry, and liaise directly with issuers even more often. In terms of engagements, our free engagement is engagement meetings, one-on-one with the research teams, in person before COVID, that is impossible, and virtually now. So they can take place. It changed everything, really.
Not yet.
So those can take place from after proxy season to the beginning of the next proxy season. So after the AGM is before the AGM, as I say. We're already thinking about the next season, and many issuers are, and we're open for dialogue with them from that moment. Additionally, for those who wish, we have a subscription service which is free as well, and it's a data verification initiative where they can verify our data before it is published. Now it's data only, so there's no analysis or recommendations in it. And then for those who are interested, it is possible to purchase the paper once it is published for our institutional clients at the same, without giving any undue privilege to the issuers themselves. And this comes with an included right of reply, which will then be included in the report, which is a form of engagement. Now, we would hope that that issuers want to span the whole gamut and start with a conversation before going to purchasing the paper or in other initiatives. We find that's probably the most valuable, and where we can provide each other with the most useful information and value.
Nezhla, the same question as I said is also for you, but with an addition. I would ask you also which are the best team you would like to meet of a company. Head of investment, what's about? Go, please.
Yes, in terms of ESG data and kind of information out there we also have some vendors we're using. So basically the largest ones out there to gather the facts, as also Michael mentioned, to have that kind of analysis and screening as a first basis. But we would also have a look at the corporate materials, so ESG reports and previous engagements notes that we had with the companies as a basis of analysis. So when it comes to the channels, for us, it is really an ongoing process this year, I would say, and then last year. So previously it was before voting season, after voting season. Right now we see really an ongoing dialogue with investee companies, and it is being very helpful. What we usually do is we send kind of an engagement letter in the beginning of the year to the investees that we have in our focus for analysis, inviting them to a dialogue. And then throughout the year, we will have different screenings, the issues we want to focus on. For example, this year, the biggest topic was climate change and how the boards are responding to that, also COVID-19 implications. So then we would usually have our engagements with the investor relations or board secretary representatives. But I would say the most obviously successful ones and the most informative ones are the engagements we have directly with chairpersons of the board or of certain committees, for example, remuneration committee. Are doing usually a governance roadshow to discuss the different updates they want to make to their executive plans. And there it is really important that we have this kind of exchange of expectations and good standards from an investor perspective. And the lead independent directors, it is quite a new role in the corporate governance area, which I personally find quite useful to consider this balance of powers within the board. So these are very informative. And obviously the senior executive CEOs and CFOs, we have portfolio management and analysts have regular company meetings with them throughout the year.
You said a lot of interesting things, and there is so much to speak about, but as I say, the time is running, and hopefully the first initial technical issue robbed us some time. So I need to stick to our defined scheme, because I want to give to the Platea some insight on what to expect on next year. So one trending topic is about remuneration, what companies should expect on remuneration side after this special COVID year. So will investors ask for remuneration reduction? Will they look for, as usual, pay for performance, or if there is a reduction in the base salary of the workforce, as it to be reflected also in executive side? I will start again from Nezhla, going back to the round and finishing with Mr. Economou. So Nezhla, up to you, and then
Sure.
Patrick.
I'll try to keep it as concise as possible. So executive compensation, I mean, this has already been discussed. That's one of the key aspects of good governance. And the pay for performance aspect is usually anyways quite tricky to analyze and to kind of take into account different developments that we have been seeing in a given year, give it for the sector, give it from different trends that were affecting the businesses in the past couple of years. But this year we have a particularly unique situation. So if companies have set 2020 performance targets for their compensation programs, even if very recently, it very well may be appropriate and necessary to adjust those targets, since the dramatic shift kind of in the economic forecast has rendered those targets basically impossible to reach and without making the appropriate adjustments to incentivize compensation programs to account for the impact of COVID-19, companies really run a risk of not properly also incentivizing and compensating their employees at a time that increased dedication is necessary to maintain just the company and the business stability. So it will be a tricky situation. The issue is also, I would say, compounded by the fact that stock prices have, as a general matter, declined by more than 20%, and most senior executives will likely have experienced a decrease anyway in the value of their compensation due to the bonus malus they have or the heavy weighting of executive compensation towards equity. So what we would recommend and what we recommend in our discussions is that companies review their compensation programs more broadly to assess, any other actions that need to be taken. For example, a lot of listed companies should review their equity plans to assess if they have basically sufficient authorized share capacity to cover equity grant needs, and if it is necessary or to amend the equity plans and request from shareholders an increase in the number of shares available. So setting target thresholds, taking into account adjusted budgets and forecasts is something we expect. And we also expect companies to consider probably alternative metrics to the existing ones. So some more of a qualitative nature, including, successful kind of implementation of the measures to protect employees or relative total shareholder return metrics instead of absolute return metrics. So we would be quite careful and cautious when analyzing and voting on executive compensation plans, as I mentioned, because the maintaining of the company's stability would be key without simply reflecting the negative implications of the crisis.
Patrick, I would say that Nezhla gave us a full picture despite in 3 minutes only. So this is a good guidance for Glass Lewis in analyzing, but I have nothing to add, but it's your role, so feel free to add something. Patrick.
Sure. I guess I agree with everything Nezhla said. The only thing I would add is that companies have been affected to a different extent individually, and that would factor into our analysis as well. Some, even though they're negatively impacted, have performed relatively well compared to their peers, and that is something that we will take into account. In general, the expectation is that for bonuses, at the very least, this year are likely to be lower. Often, while a company that has experienced a very significant negative impact might need to rethink the incentives because they're incentivizing for something slightly different now that the situation has changed radically. For those that are less negatively impacted, perhaps the bonus can be left to run its course largely unchanged. So we're going to be monitoring not just what Nezhla said, but also how much the experience of shareholders and stakeholders, including employees, is shared by the executive team.
And Michael, so we understood that there is the possibility of more allowances to a discretion of the board to realign the target. Is this also a BNP thought?
Well, of course, the target that has been set up early 2020 before the crisis doesn't make sense for a lot of sectors. So in theory, I would say yes. In practice, I'm a bit afraid, to be honest, of what will happen. Why? Because, if we look at our figures this year, with a year that was not concerned by the COVID crisis, because it was on last year results, we voted against 60% of remuneration proposal around the world. So almost 2/3 of the remuneration proposals, say on pay, whatever type, in average. So we have already a huge high level of dissent on this kind of proposal for several reasons. And one of the reasons, I mean, few reasons. We have voted down a lot of companies due to pay for performance issue. We have voted down already a lot of companies that were setting targets that were below expectation or below what the market was, what the company was saying to the market. So, I mean, just giving this initial picture before crisis. So I would say in theory, okay, yes, I understand. I mean, the targets need to reflect the reality. But on the other hand, a company need to be really cautious because it doesn't mean that there is a blank check from investor. Already before the crisis, we often challenge company and vote down remuneration schemes due to due to target issues. So next year, I mean, probably going to continue. And even if you revise, and we understand that, I mean, you shouldn't do something that is that doesn't make sense. That plus, of course, if your results are going down, if you're having employees layoff, all this situation can be quite explosive, and that's something that we look for. So I think that, I mean, the expectation is that compensation should follow performance, and performance is will be not good for a lot of companies. So remuneration should follow, even if compensation are adapted to this new situation. I think that's what we will really matter. We always look at this, but clearly when you're in a market that is growing and prices are going up, the pay for performance is looked at, but usually less problematic when you're in a year that is the opposite with negative or bad results. Clearly, the pay for performance is going to be probably one of the criteria that will be the main focus.
Argiris, no, it's up to you, but I don't want you to go technically about remuneration scheme. My preference is to explain us which is the time limit, because we spoke about adaptation, changing of conditions, which needs to be reflected into changes of proposals. But I know that drafting a proposal for a general meeting or any type of proposal is something that requires time. So how can a company face changing in circumstances, reflecting them into documents that need to be crystallized?
I would not like to talk about specific dates and the deadlines because to me it is an ongoing procedure which is going to last and last and last. Uh, First of all, let me tell you that I could not say it any more better than Mr. Herskovich regarding dilemmas and questions and concerns related to the business conduct of the company. So I'm just seconding what he said on those issues. Second, you do know that PPC has already entered into what is, for a large number of people, perhaps the greatest and largest business transformation of any company in Greece of all times. You do understand that this is a huge challenge for us. And we hope that we will be performing according to expectations and wishes of not only the management of the company, but also of our shareholders and stakeholders. This transformation will not be a 1 or 2 or 5 years period process, but it will be an ongoing transformation and we'll have to adapt accordingly to what the international environment on those issues is also changing. For instance, we should take into consideration what Mrs. Ursula von der Leyen said yesterday in the State of the Union address, which she made before the European Parliament. Those issues related to the transformation of PPC from a company which was mainly a fossil fuel generating company into a green company has certain milestones to be observed and achieved. You do know they have been already publicly announced. Within this framework, of course, it is well expected and understandable that also issues related to compensation schemes will have to be followed. For instance, my own bonus at the end of the year will be related to the implementation of the business plan, which includes the transformation of PPC into a green company within the next 2 or 3 years. So it is already in place, but I would not like to get into too many details about what we are about to examine and recommend to our perhaps even our shareholders meeting. So PPC is transforming. I think that so far the results indicate that this process, which is a very challenging, I cannot emphasize how much challenging is it. So far the results show that we are doing rather well. Okay, the price of the share yesterday went below the day before yesterday, went above €5 per share, which is a price we have not been seeing for quite some years now. So we're very optimistic. And of course, I like again to repeat, this is an ongoing process which will be transforming and adapting what the business environment will indicate us to align also with the expectations of the markets. So it will be an ongoing procedure of checks and balances, adapting to the changes of the business environment in which PPC operates. I do not know if I have answered according to your expectation. This is perhaps the best I can do.
You are pointing out the point of view of a person feeling, trusting what he's doing. So nothing better than that could be the answer.
Thank you very much.
No worry. I guess we are now running out of time, so I just need to thanks everybody for being here, for sharing with us your experience, and hopefully just saying hello and goodbye to the next meeting, which will be among us in off-season engagement.
Thank you.
So,
Thank you.
Thank you. And
Thank you.
Christos, up to you the stage.
Okay, Alberto, thank you very much. I was listening. That was very interesting discussion and quite pleasant, I must say.